Live from Connecticut. Here we go. This is going to be an interesting week after Friday's big job report. We've got a Fed meeting next week. So there's going to be a lot of chatter around that. Markets are certainly planning for the Fed to cut. We'll get into it. Let me know where you're tuning in from here as we start this week. We are now outside of we're into a fresh week, I would say, where this week we're not going to be impacted by the Labor Day holiday. Obviously, Monday being Labor Day, short week last week. There's going to be some numbers here that we have to use context for. Hey, people coming out of summer, going back into school, all of these things. And now we're going to get our first look as we move forward this week, our first crack at what could be considered a more normal week. And it'll hopefully provide some insights on what this September and what this fall will look like. How's the housing market going to react to some of these economic concerns, some of the job market concerns, and others? All right, so let's start with jobs before we go to inventory. We look at inventory every single week. Inventory is the thing that everybody's been clinging on to as we dropped into historically low levels in 2022, and we've been on the climb back ever since. We do this show every single Monday through Thursday when markets are open, 9:30 in the East, 6:30 in the West. Make sure you subscribe down below if you're here live on the YouTube right now. But we look at inventory every single week, and we're going to get to that in a second. Let's start with the jobs. Okay, Friday's job report from Bureau of Labor Statistics showed that there were 22,000 jobs added in August. This number is not what the expectations were. The expectations were well above 22,000. And now we're looking at a scenario here over the last couple of years that shows us job growth has slowed down significantly. Remember a month ago, we saw those two big revisions. That was for June and May. Okay. These 2 months here were revised down dramatically. And now we're seeing an August number before revisions, obviously, that is coming in much softer than expected. And if you look back, going back a couple of years, you see job growth that was much, much higher than what we've seen the last 4 years. Now, if you think back to 24, particularly 24 and the end of 23, when we were looking at these job numbers on the hot sheet, we were looking at them. I'm like, man, if you pull government hiring out of total job numbers, like these are not great numbers. So I think with government hiring possibly, slowing down a little bit, it's starting to take a toll, which to me is good. We want job numbers reflective of a private investment, private sector investment. And right now, you're just not seeing that. And so what Logan Mohtashami always talks about over at Housing Wire, look for labor over inflation. Inflation is the easy thing for the Fed to continue to talk about, but really their second mandate is probably the most important one of all: maximize employment. If employment numbers go down, what follows? A recession follows. And Jerome Powell, for his legacy, for how they talk about him 10, 20, 30 years and beyond in the future, what he does not want is a recession on his hands. One that he could have helped basically put on the sidelines. He doesn't want to be the reason that a recession ensues. And when labor starts to weaken, it becomes obvious what play the Fed needs to make. What do they need to call? Okay, you had a lot of new coaches over the weekend on NFL Sunday, and some made really good calls, and some calls were made, people were scratching their heads. Okay. We'll see tonight. I mean, if you're a Bears fan, they've got the brand new coach from the Lions. Lions looked terrible yesterday. They lost the play caller. Now the play caller's in Chicago. Is Chicago all of a sudden going to look better with the plays that they're calling? Okay. But you you've got one play that you can run if you're the Fed when labor weakens. And that play is clearly going to be to lower rates. You're seeing the indications now. The market's pricing it in. It's just a matter of how many rate cuts we're going to get, not if we're going to see one next week. And the market's a much better indicator of rates anyways than the Fed. And so market's pricing this in early. We're not going to see a rate cut next week and all of a sudden the 30-year mortgages and a 10-year, because the 30 years is going to follow the 10-year. We're not going to see that drop to 5.5. This year-to-date low that we got on Friday is pricing in what the Fed's going to do, and more importantly, pricing in what the Fed's going to indicate for the rest of the year. The market's already got this rate cut in September priced in. So you remember, I'd rather be an early mover on rates. I was talking to someone who's got a very expensive home on the market end of last week. And I was, talking to this person on Friday afternoon, and they're like, hey, see what the Fed does next week or week and a half, see if they lower. Hey, they're going to lower rates, and it's not going to impact the 30-year fixed. The impacts are happening now in real time. Be an early mover if you're going to make a price adjustment to your home. Be an early mover if you're a buyer on the sidelines. Think about the buyers in 2020 who got out of their house in May and went and scored a deal. They not only got the low rate, they got the low price on the house. The buyers in May of 2021, they had to see 12 months of headlines to realize, oh, rates are low. Oh, money's cheap. Oh, housing's popular. I should do what everybody else is doing. And once I buy the house and close, I should do one of those dancing trends on TikTok. Tell everybody about how happy I am for myself. No, the buyers who bought in 21 did significantly worse on price. They did great on rates, and I think you should have been a buyer in 21. But they did significantly worse on like home run deal than the early movers who bought in 2020. Early movers win. Those who wait, like I'd rather show up. People don't want to show up to a party too early. I'd rather show up a little bit on the early side and figure out, hey, is this going to be a good party to stay at, or should I bounce out now? Okay. Then showing up when everybody else is there and everybody's trying to convince you this is the place to be. No, I want to be in full control. Early movers on the market right now are in control of the negotiating. Okay. Unemployment rate ticks up while these job numbers come in soft. Unemployment goes up to 4.3. Now, if you look at the last 2 years, it's like, oh, unemployment's rising. I'm not worried about this number at all. I think really unemployment, you could consider it being pretty much healthy or normalized at 4.5, and we're at 4.3. We got 7.4 unemployed people. That's about how many job openings you have too, by the way, just over 7 million. I'm not saying that the 7.4 million unemployed can go get a job with the 7 million. I'm not saying that there's any kind of match there, and don't get your panties in a bunch about that. I'm just saying, like, hey, we're still trending near very low unemployment levels. The bigger concern for the Fed is this lack of job growth. It's a concern for, a stagnant, GDP numbers down the road, an economy that could be declining. Okay. We talk about inflation much more than we talk about stagflation. Stagflation is a real concern, I think, for some that are looking at this with an objective view. Okay. So if we look at this unemployment rate here, I'd argue 4.5 is totally fine, totally normal. 2016, when we were still kind of on the tail end of a recovery, 2017, even, we were up over where we are today. 4.3 is really low. I mean, just taking a look back at the last 20 years, we really have never been at 4.3% unemployment for a sustained period of time outside of these last few years. These last few years have been the best we've seen on unemployment. We got down before COVID to 3.5, February 2020, 3.5. That was, again, That was a historically low number at the time. If you remember, February 2020 it was a fourth year of, you know, Trump 1.0 was something he talked about all the time, being winning this unemployment battle over the 4 years. Well, after COVID, we printed all that money. We got that number back to 3.5, even lower at one point to 3.4. Employment came back in a big way. Think about all the PPE money and the money that was pumped into the economy, and businesses were able to invest. And that number hasn't changed all that much. 4.3%, while it has ticked up, is not to me, a concern on unemployment. I wouldn't even be concerned at 4.5. That's where we're at. But with unemployment ticking up and with job growth really becoming stagnant now, not only for 1 month, but now two major job reports in a row, you're seeing a real market reaction, one that is driving the 10-year Treasury yield to probably the lowest level we've seen, sustainably over definitely over the last 6 months. You had one other moment in the last 6 months, in April that got a little bit lower, but right now we're sitting at a very good spot at 4.055. Can we break 4% this week? We're starting the week here with it going even lower. If we look at the last month, we're certainly at the lowest level we've seen in the last month, and the lowest level we've seen in the last 3 months. 4.055 is where we're starting. That number really shot down last week, and you can get our full instant reaction over on Knowledge Brokers podcast, me, Tom, and Lisa. We recorded right after this news on Friday, so we spent some time on this. You can go over there and check that out if you haven't done so already. But obviously, Friday's 30-year fixed rate shot down to 6.29. It was the biggest one-day drop of the year. Biggest one-day drop we've seen in the last 11 plus months. I think it was certainly year to date biggest one-day drop, and we may even see this thing get under 6.25 as we sit here and start at a lower 10-year rate today. The spread between the 30-year and the 10-year, because really the 30-year is going to follow this 10-year. Like I said, the 30-year mortgage is not going to follow what the Fed does next week. 30-year mortgage follows 10-year Treasury yield, plain and simple. Follows the bond market, and the bond market is already pricing in what Jerome Powell is going to get up there and do next week. Okay, the Jerome Powell puts a stamp of approval on what the market does. You think the Fed, with a bunch of 12 appointed people, are smarter than the markets? I don't think so. Okay. The Fed's, not filled with a bunch of people who have ever done anything, all that interesting when it comes to investing. If they made all their money investing, they wouldn't be on the Federal Reserve. Okay. Let's just face the facts. They wouldn't be serving the public if they were great at the private sector. Okay. They'd be continuing their wins in the private sector. So I'm going to follow the market, and the market is already pricing it in. Now, the spread between the 30-year and the 10-year has gotten better, which is helping these rates now into the low sixes. If we just take last year's spread, we'd be much closer to 7% today. Okay. If we take a normal spread, which is actually below this 2% line, while we're getting better, the spread was, it was up near 3% at times in 23, 2.5% at this time last year. Right now, the spread between the 10-year and the 30-year rate mortgage is 2.27. We get this thing down to like 1.8, which is normally what it is. We're sub 6% on the 30-year fixed. Okay, so the 10-year could sit or even go up a little bit. And theoretically, if the spread continues to get better between the 10-year and the 30-year mortgage, you could see high fives going into next spring without labor crashing. I mean, I think that's kind of like best case scenario. Okay, you need for rates to really go down, like for the market to price in, the Fed is going to make dramatic multiple cuts here in the future. as opposed to a quarter, type of move, to make fast moving action. For that to happen, that means they've got to be really concerned that we could be going into a recession. Now, that'll bring rates down for sure. But if we're dealing with a recession, how deep does a recession go? And how much time do we need to recover? All that's going to impact the housing market. Okay. So, kind of a better case scenario is that we have a economy that is actually doing well. That is almost, dare I say, thriving in 2026 when the US turns 250 years old. It's one of the ambitions, obviously, for the new administration is to have a booming economy in 2026. Now, if that were to happen, how do you have low rates to unlock the real estate market, to get real estate out of the real estate recession? Well, this spread continues to improve. That's how you get there. And so if we have the spread continuing to improve, we could end up still sub 6 going into high 5s. I think that's a good place if we're heading into next spring. Fannie Mae, remember, projects 10.7% increase on existing home sales for next year. I don't think there's any chance we get there unless the majority of buyers have a 5 handle. You can get there if the spread continues to improve. All right, how much inventory is going to be out there for those buyers as we get into early 2026? We know we're entering seasonal decline on the single family inventory, but this decline is happening much sooner than I would have imagined it would have. Certainly, if you compare this year to last year. Okay, so now I'm going to throw this week away. I'm going to do a little bit of a, little throwaway here. It's like, you've got Barry Bonds in the box. I don't want to just groove them one down. I'm going to put one into the right side of the batter box. Like, I'm going to throw one away here and see if I can get a wild swing before I start pitching to him, or I'm not going to throw him one at all. But I'm going to throw away last week. Okay. It was, accounting for Labor Day holiday. You've got back to school last week, and you just got a lot of stuff going on. People wrapping up summer, maybe getting back to, back to home from vacation, back to school, and all of it wrapped into one. You saw inventory on single family homes, according to Altos Research, decline almost 15,000. Now, the same week last year, we saw an inventory decline, but it was about 1,200 homes, okay, nationally. The decline this year was almost 15,000 single-family homes across the U.S., dropping from 860,700 plus to 846,500 plus. Inventory versus last year is up 20% year over year, but we had a point this year where that gap between this year and last year was up over 33%. We've now shrunk that gap to 20%. We're doing better on inventory, yes, but this decline is starting earlier than last year would have suggested. Okay, if you just take August, when you would expect, especially based off of what we had last year, an inventory increase, we actually had an inventory decline in August. We were net negative on inventory in August. If you think about inventory in August of 24, we started at 683,000 and we ended at 704,000. We gained 20 plus on active inventory for single family homes in August of last year. We continued to gain through September. Before the end of October is when we started our seasonal decline. So the seasonal decline is coming in earlier. Again, I'm going to throw last week away. It's this week when we come back next Monday that I'm really going to be interested in to see if we have a bump up, a significant bump up on active inventory. Okay. And that'll have to primarily be driven by new listings. New listings come in over the holiday week at 64,600 plus. So a positive sign there, a sign that would tell me that, hey, we could see some new listings this week that change this story a little bit. I'm going to pay attention to these next 7 days closely, versus last year, 61,900. So Not a crazy number. Last year, the week after Labor Day, if you take a look, if you're driving, don't look. But if you can see your screen, last week after the holiday, we went up over and had 70,000. It's the only time in the fall last year we broke 70,000. So are we going to get that post Labor Day weekend bump on new listings that'll help the inventory recover here from this big decline that we saw here last week? But there is there's no question about it. You got 5 weeks of data now. August, holiday week in September, there's a little bit of a hesitation with sellers. They're not totally comfortable being on this market. Now, they're a little more comfortable sitting back and saying, I don't need to sell, so why would I? It's a real conversation to have as buyers negotiate and as sellers make decisions on what they're going to do. The sellers that are committed to the market are reducing at a higher rate than we've seen in really the last 3.5 years. Price cutting at a 41.5% clip today. We only saw a higher clip than that in November of 2022 when the interest rates really started to make their impact. Those restrictive rates that the Fed laid out at rapid fire back in 22 created some level of uncertainty in the fourth quarter of 22 with home sellers. And that's the only time in the last 3.5 plus years that we've seen higher price reductions. So sellers on the market are reducing at a higher clip. On the flip side, buyers are taking out mortgage applications anyways at a higher clip. We haven't seen this relative to pendings or closings yet. We're still rolling in on these low levels. But there are more buyers thinking about going out and buying in the future. Applications is a leading indicator. We've had 16 positive readings on mortgage applications for the year, 12 negative readings, 6 flat prints. But here are the two big ones: 31 straight weeks of positive year-over-year data and 18 consecutive weeks of double-digit growth year-over-year. We're still at the low levels of the GFC, the Great Financial Recovery, as it relates to mortgage applications. And before that, you'd have to go back to 95. So, yeah, in the last 30 years, we're in one of 3 the lowest levels on mortgage applications, but we're seeing 31 straight weeks and 18 consecutive weeks, double-digit growth, that are telling you the future is going to get better as it relates to buyers re-entering the market and using a mortgage. And as these rates improve, those numbers will follow closely. And I would expect, as the rates continue, this week will be an indicator that this number will continue to improve off of 12 months prior. Right now, 65,000 weekly pending sales. Same week last year was 62,000. Okay, we're not really at any great measurement when you look same week versus same week last year, pulling away on pending home sales, but we are showing some signs of improvement. Pending home sales, obviously one of the lowest levels we've seen relative to population and home buyer age. If you look at total pending home sales over the last 2 years, it's 359 versus 357. So we're still trending towards that 4 million existing home sales, which is a really low number, depressingly low if you want a fluid real estate market. But what does Fannie Mae say? They say next year that number is going to be up 10.7%. And if the rates start to cooperate, which we've seen some signs of recently, there is a world where I can see that happening. There's a world where I can see double-digit growth on existing home sales. That world leads with a 5% on the 30-year fixed mortgage rate. How bullish, how dovish is Jerome Powell going to be next week? A lot of it relies on his commentary, not actually what he does. We know what he's going to do. Okay, everybody knows what he's going to do. He's boxed into a corner. CME Group says 88% chance what he does is a 25 basis point cut, and a 12% chance that what he does is an actual 50 basis point cut. What he will do is reduce. He has to. It's a mandate from Congress to maximize employment. He's got the data now to tell the market, yep, I'm going to reduce. And he'll do that next week. Polymarket. Okay, so this isn't DraftKings, but you can bet on it. Poly Market is a betting site, and people putting their money down think it's an 87% chance. Rather, it's only a 25 basis point cut versus a 50 basis point cut. 10% believe that that'll be the case. 3%, these are your true doom and gloomers, say that there'll be no change, or they placed that bet so long ago it's like lost money on there on Poly Market as the money is pouring in to Jerome Powell making a cut. What's more important, and where rates will move next week, if they move, is going to be if Jerome Powell says, hey, we're making a 50 basis point cut, and we're going to probably be making a 50 basis point cut on the next meeting. Nobody's really accounting for that. That will rewrite what the markets are doing in a significant way. I'm not predicting that. Nobody thinks, Poly Market and CME Group doesn't think that's going to happen. But if he comes out and says that, you will see these rates move significantly. Other than that, I think a lot of it's priced in. So right now is the week to get out in front of people who have been on the sidelines and let them know, hey, this might be a window. We've seen these windows close fast. Powell comes out next week and wants to hold firm on uncertainty and, whoa, watch out for inflation. If he wants to play that game next week while doing a cut, but be uncertain about where you could see actually rates go up as he cuts rates next week. So it's going to be a lot about what he says next week. And so you may have a window right now as somebody who's a buyer that they need to take advantage of. Okay. Realtor.com has a report out specifically for sellers. I think if you're a real estate professional, internalize these reports. Okay. We're seeing a hesitant seller. So seeing in the minds of a seller is really important, and being armed with the data to have the conversation to put them in the best position to succeed is going to become more and more important as we get closer to the seasonal decline that is coming at the end of this year, and then the ramp up period going into next spring. Hey, your best spring listings, the conversation starts now. Your best spring listings, the conversation starts and the planning starts over the next 6+ months. Okay. What's the market dynamics right now? Okay. So the homeowners right now, the market's different than the last, than the one that they last sold in. Okay. Nearly half, 45.2% of today's homeowners have lived in their home for more than 15 years. Okay. 15 years ago, 2010, we were in the middle of the biggest cleanup economically of our time. Okay. 2010, we were in the middle. 2009 market crashes, 2012, the second bottoming. We're in the middle of the cleanup. Unemployment high, really bad economy, a lot of concerns 15 years ago. Okay. 1 in 4 homeowners have lived in their home 25 years ago. I mean, everything's different than 25 years ago. 25 years ago, Haley, you'll appreciate that. How old are you, Haley?
24.
Okay, Haley's 24. So I guess she won't appreciate this. Haley, 25 years ago, if I wanted to hang out with one of my friends on the weekend, I would call, and then, his sister would pick up or his mom would pick up. Byron, how can I help you? Hey, I'll just use the name Bobby. Is Bobby around?
That would happen to me too.
You would do that? You used the house phone?
I did.
When? What year did you use the house phone?
Elementary school.
Okay. Maybe. I don't know. Maybe. Not buying it. But I guess so. Elementary school probably had a couple of years of that. A lot of things are different between now and 25 years ago. And so 25% chance that you're walking into a seller's home and they haven't even, sold since 25 years ago. Hey, Zillow wasn't a conversation on a listing appointment 25 years ago. Among the oldest homeowners, this trend is stronger. So if they're 65 plus, 70% of these households moved before 2009, roughly half before 2000. In other words, typical 65 plus homeowner has lived in their home for more than a quarter century. Here's the homeowner tenure by age in front of you, if you can see it. So you got to adjust kind of what they might think selling in the market is versus the reality. Okay. Over this time, the housing market's transformed. Existing sale prices have tripled from 145,000 to 435,000 in 25 years. Home prices versus now income hasn't followed the same trajectory as home prices. You can see it here. Now, home prices outside of the great financial crisis have always been above income. This is America, baby. People spend above their needs. Like when you talk about this whole like income needs to keep up with home prices, not necessarily. No other country has a 30-year fixed mortgage. It's never happened outside of the GFC, the great financial crisis recovery. I mean, other than that, last 25 years, home prices have always been higher than the income index. Now the gap is much wider than it's ever been, and that's going to be a concern, obviously, for a lot of people. Existing home months of supply. Just look back to 1982. We're still at a near record low level. Okay, if you take COVID out, these are the lowest levels we've seen. I know it's pre-pandemic levels, and those were low levels going back to 82. Look at existing home months of supply. Take COVID out, take the post-COVID low rate bump out, and we are still at a, I mean, this ain't the 90s, okay? This is, the 90s consistently were much higher on months of supply, okay? This isn't Mariah Carey swinging on a swing underneath a tree. This is new times. This is Taylor Swift times. So we're dealing with a much different market. Understand that if you're a real estate professional going into a conversation with a seller, one out of four sellers, it has been 25 years since they've sold. How we market properties is different. How you position them, how you price them. Coming soon wasn't really a thing in 2000. Okay. All right. So that report's uploaded into school for you. If you're interested in that report or any of the slides that I used, BAMX members, you know how to get it. Just go into your hot sheet classroom on school. I give all the slides every single day in that classroom, as well as all of the notes. So that's all there. Hot sheets obviously brought to you by Zudilio, a BAMX partner. Zudilio gives their platform, which is a ridiculous $2,400 value a year to BAMX members. You can get a BAMX right now for $970 a year or $97 a month. We basically pay you to be in BAMX. Zudilio helps you compete with Open Door. They protect agents, and they also give us great data like this every single week. Top 10 housing markets for cash offers. Top 10 for the week ending 9/5 is Vegas, Atlanta, Houston, Jacksonville, Raleigh, Dallas, LA, San Diego, Phoenix, Miami. So a couple of those Florida markets dipping off from last week. You've got California, Vegas coming in at number one, man. I think for everybody talking about Vegas this past summer, like, Vegas, it's getting scary. Not a lot of tourists in the summer. I think Vegas is going to surprise a lot of people over the next 5 years. I'm bullish on Vegas. And look where investors and cash offers are. Number one for the past week. Vegas seems to find themselves in the top 10. Listen, baseball's coming. I think there's a lot of things. They've already got the NFL. There's just a lot of reasons to be bullish on Vegas's future. I'm in that camp. So the camp that you should be in this week, though, is this one on Wednesday. Okay, this is open to everybody. So it's a free webinar. BAM, our model, give everything away for free. If you want the done for you content, the consulting that we do in BAMX, then obviously go to school.com/BAMX. But this webinar is free. It's myself, Scott Harris, who spoke at BAM BBQ, and he's the CEO of experience.com. Going to be talking about how to dominate Google and AI search. Like Lisa Chinati at BAM Camp is going to be sharing with everybody. BAM Camp is sold out in Arizona, September 24th, Scottsdale. Looking forward to seeing any of you guys there that are going. But she's walking through how she's generating organic leads right now on Chat GPT. She's up like plus. I mean, I don't even want to give the number. She's up multiple tens of thousands on. I'll let her share with you guys that are going to BAM camp on what she's doing on chat just in the last 30 days alone. Scott and I, the time right now is right now, fourth quarter, to get this stuff cleaned up. We're going to be talking about how to dominate Google and AI search. So live search ranking audits. If you're a BAMX member, hit me up in BAMX and say, hey, on school, and say, hey, I want my search ranking audited. We'll run it through the system and audit it for you so that you can be ready for AI search. Okay, this is free. Haley put the link down below. Join me on Zoom, 3 p.m. Eastern on Wednesday. And for BAMX members only, I'll see you guys tomorrow, 9 a.m. for our live role play right before the hot sheet. So we do that every Tuesday, 9 a.m. A lot going on this week. Really pleasure to kick it off with all of you. I will see BAMX members tomorrow, 9 a.m. in the live role play that want to jump into that. And I'll see the rest of you 9:30 tomorrow Eastern time for the next hot sheet. Until then, have a great start to your week. And of course, toodaloo.